But anyway, welcome to this webinar. Today we're going to talk about from the offices of Putney in this hot and humid day in West London. We're going to be discussing why end-of-day trading will save you time, money, and sanity, of course. Okay, I'm going to basically talk to you about the merits of end-of-day trading and why it could benefit you, especially if you're newer to the market or you've got a relatively small to medium-sized account. Okay, and it could mean for many of you the difference between an experience like this and like this. Okay, I know it might seem a little bit cheesy, look at the different pictures there, but as I discuss in this webinar, you'll see for yourself why and above it can really take the agony and suspense and losses out of your trading. Okay, so just very quickly, I run the lazytrader.com, which is a global brand. I've been running it for the past 3 years. I've been trading for the past 8 years, and I've been trading currencies, stocks, commodities, and of course have been contributing to FX Street in and amongst other publications, both online and in print as well. But that's enough about me. I'm pretty sure you didn't take time out of your busy schedule to hear about me rambling all day. Let's get to the pith of the webinar. Okay, forgive the sirens in the background. I promise you I'm not broadcasting from the ghetto of London. Our offices are located in between a fire station, a police station, and a hospital. So that would explain the noise in the background. Okay, so please get a sight of the disclaimer and then we'll make a start. All right, so why do we trade the higher time frames? A lot of people, when they certainly come to us for mentoring, are quite perplexed as to why we why we don't really go in for the smaller time frames like the 15, 30 or hourly time frame. Well, the daily chart or indeed the weekly is more reliable. We can get a better perspective of the market. We can get higher reward, and it's less emotional to trade. Sure enough, we typically have a much bigger distance between our entry and our stop loss, but for that sacrifice, we're able to have a much more peaceful trading experience. And certainly when we do place our trades and walk away for the rest of the day or indeed the rest of the week, it's the difference between us working for our money. You know, you've seen these images there when we're just tied to the desk, watching our trades, whether it's an intraday trade or indeed a scalp or anything like that. And we're watching that stomach churning experience, watching the position either go in our favor or going against us, or indeed that zone when we're in purgatory and we just don't know whether it's going to go in our favor or not, and it just does nothing, or money working for us, and where we can just set our trades up and walk away and just simply be rest assured that, okay, if the trade goes in our favor, we can make a certain decent percentage potential return, or if the trade goes against us, we can only lose a limited amount, like 1 or 2% of our trading account. Okay, so lifestyle trading, we call it trading end of day on the hard time frames. The reasons why, essentially, it frees up time, removes emotion from watching the charts all day, money working for hard for us rather than it being the other way around and us being changed to the desk. It means that we can essentially benefit from a much more stable time frame. The hard time frames, it takes a lot more news and volatility for those hard time frames to be affected, which is great. It means that by and large our trades are immune, not all the time, but by and large they're immune to a lot of the news announcements out there and these inexplicable spikes we can sometimes see intraday. It means that we can catch bigger moves, get more pips and more potential percentage points, and they are far less time consuming to manage. And we're not at the mercy of being logged on to the internet all day, like some styles of trading we are. We don't want that. We want trading to work for us. We don't really want to work for our trading. Okay, so how do we achieve that? Well, we look at the daily time frame and we have a fixed awareness for our strategies rules for entry, and we select a battle-tested strategy. We keep the risk low, and we find some distractions from the whether that's a hobby or an interest or indeed another business idea. Okay, so as I just mentioned to you, the harder time frame, the stronger the trend. It means that we can essentially take advantage of bigger picture moves, very much like the trade we took off the back of this year's election, where David Cameron came on top of Ed Miliband, thank God, and we took advantage of a very decent move with the British pound against the Australian dollar off the back of that. Okay, the harder time frame, the more clarity it gives us as well. We're going to be looking at some examples as well, so don't worry, I know this is very theoretical. We can also, this is the important one, I think, the most important thing, is that we can always be in the flow of opportunity. Suffice us to say, if we're trading the 5-minute chart, or God forbid, or indeed the half-hour or 1-hourly chart, it puts us under pressure to be in front of the screen. Say, for example, we get a setup manifesting itself in the market, and say, for example, we get 3 setups a day over the course of 3 26 currency pairs, 2 lose, and we know that the next one statistically could potentially be a winner, but it doesn't manifest itself until later on that day. It means that we're chained to the desk, and we have to be. It puts us under pressure to be in front of the desk. Whereas if we're trading the daily, then we can only look out for one potential opportunity per pair per day. Obviously, we don't get that many per month, but we don't always have to be in the opportunity flow. We get one chance to look to see if there's an opportunity a day, and we do that rather than looking every hour at the screen. Okay, and this again is crucial. I mean, a lot of people who are new to financial markets trading struggle to realize that make 8% on their trading account in a month, which is a great return, by the way. I'll be happy with that in 2 months, for example. But anyway, Jack trades intraday for 30 minutes an evening, and John spends hours a morning trading as an intraday trader. Consider there was an average of 22 days in every month. Jack has a total of 11 hours spent glued to the screen, while John has a total of 88 hours glued to the screen. Who do you think's got the better time reward return from that? The end-of-day trader or the intraday trader? Who do you reckon? It's going to be Jack, isn't it? The end-of-day trader, because he's made the same return as the intraday trader, John, but he's spent far less time achieving that reward, okay? And this is the great thing about financial markets trading. It's not linear like it would be when you're swapping time for money in a day job. If you're, for example, on a wage, in the wage system, when you're earning like a fixed rate per hour, it's the potential reward is disproportionate to the time spent, and that's key to trading, okay? And another thing with end-of-day trading is instead of the intraday inverse reward or the one-to-ones reward outcome trades, which we typically get, and we're under the extra pressure to trade those setups, is that even though the frequency of trading might be far less end-of-day, we at least get or are able to take trades of a high reward potential. For example, we look for 3-to-1s. Even some of our trades have a reward to risk of 5-to-1, 10-to-1, even 20-to-1. Some, although they seldomly occur, I will be honest with you in that sense. But the world's your oyster when it comes to end-of-day trading and profit potential, especially if it's a range-based trade where it's a simple case of buying the bottom of the range and selling the top, pretty much like what we're doing now with Euro and GBP. I'm going to talk to you a little bit about that trade we're currently in a short while. And another key aspect of end-of-day trading is that it's far less emotional, okay? We simply place our trades up with our broker in the evening. We have a good idea as to why we place a trade based on the rules of our setup and our strategy, and we've accepted the reward potential if the trade goes in our favor, but if the trade goes against us, we know that we've lost a very small amount if we're trade sizing, which we all should be, by the way. Never risk more than 1% of your trading account, no matter how good the trade looks or no matter how good the trade doesn't look. That's absolutely crucial. Okay, so they're the benefits of end-of-day trading over and above intraday trading. I absolutely swear by it, and a lot of people who come to us for training, of course, they've started off intraday trading and they've taken quite a few knocks and they gravitate eventually, albeit stubbornly, to end-of-day trading, but they quite often find that it's an expensive, time-consuming folly converted into or transformed into a carefree and relaxing hobby. And that's what trading should be. I mean, I'm the first one to admit that I don't spend much time of my day trading. I scan the markets once in the evening or first thing in the morning if I'm out and about enjoying the fruits of West London. But, you know, I've got other things going on in the daytime, and I find, and this is the filthy revelation, which a lot of people are surprised to hear, I actually don't find that financial markets trading that interesting. Sure, I love to use it as a vehicle in order to make a good percentage return at the end of the year, but you'll never catch me volunteering the subject in the pub or out and about, really. I just happen to use it and trade as a business. I don't really have much interest in it as from an intellectual point of view. Believe it or not. Okay, so I'm just going to talk to you about a strategy which we can trade on the daily. It's quite powerful on the daily and the weekly, but you know what? If you aren't swayed by my enthusiasm for end-of-day trading, then you can at least trade it on the 4-hourly or indeed the hourly or the half-hour. But of course, if you trade it on the smaller time frames, you all have to have an awareness for news releases and those days where we get very, very well, volume is light essentially, and we don't want to trade on those days like Bank Holiday Mondays where volume is light because there are a lot of stop runs, a lot of false moves, and the markets don't really run in a very efficient manner at all. Okay, so we've already talked about this, the daily and the weekly timeframes. Although I'm that passionate, I'm just going to summarize why they're that good or great. They give us a clearer market perspective. The market structure is better established, i.e. we can get a better, more broad-brushed view of the market in quick time. Levels are far stronger and better established. They're typically the levels at key round numbers like 00, 000s, or parity, where the major banks and institutions have their orders, and we can enter bigger moves with minimal effort. Okay, so this strategy here, it's a trend-based strategy, as you've probably picked up with the clue in the title. There are pros and cons, like there are to any strategy, really. There's no perfect strategy which works the whole time and is completely perfect. They all have their unique idiosyncrasies. Okay, so the great thing in favor of TradeRider Pro is it means that we can get into big moves once they become confirmed by the trend. We can benefit from a free trade earlier, i.e. moving our stop loss to break even once we have a sufficient amount of pips on side in favor of the direction of the trade. We can piggyback the underlying sentiment easily, so we don't need to be these people moving the markets. We can just piggyback the people who've already moved the market, which is where we make our money as retail traders. We can take advantage of a reward, or far better rewards, being on the higher time frames. Your style epitomizes set and forget to its highest degree. It doesn't require the use of indicators. Of course, we do look at reversal divergences sometimes, but for the purpose of this, as a vanilla price action strategy, we don't necessarily have to. It's not essential, okay? Indicators are used as the icing on the cake, but throughout my years as trading, I've become less and less interested in indicators, which all lag, by the way, as time goes on. Okay, so the cons to this strategy are typically the opportunities are fewer and far between. A lot of people who are new to the markets don't like being out of the market. They're fearful of missing out. Well, guess what? When I was new to the markets, I had exactly the same fear. Okay, I had to be in a trade. I really, really resented not being in a trade, and I always had to be in the action. I was so scared of missing the kind of the 100 or the £100 bagger, as it were. And but funnily enough, actually, as I came to realise throughout my trading career, the hard way that is, that it's actually the trades that you don't take are the ones that make you the money. So unless you see a trade setup which conforms to all of your rules to entry, then you can take great pride and satisfaction from being disciplined and patient and not trading for trading's sake. Okay, because that's something amateurs do, and that's something they get punished with quite quickly when they're trading. Okay, but it's something we've all gone through. I'm sure anyone who says that they've never done this before is probably lying to you. But it's something I'd say it's the better man or woman that puts their right foot forward or the left foot forward and admits to their idiosyncrasies in trading. Once you can be true about your own weaknesses in trading, you can be true to yourself and you can rectify that. It's a common temptation in people's psyche when they're new to the markets to simply sweep their lack of discipline and lack of patience under the carpet and just say, well, yeah, I just thought I'd do it this time. Next time it will be different. That's often complete nonsense. Okay, so back to the strategy. I digress. I do apologize. So in a nutshell, what we want to do is buy the dip in an upward trend and sell the rally in a downward trend. Nothing too earth-shatteringly difficult about that, or is there? Well, let's have a look here. Okay, so we want the established upward first. We want to wait for at least the first higher low to form. Then we can buy the pullback on the second pullback, or indeed the third. And of course, on the flip side, when we've got a downward trend, and we're going to talk about moving averages in just a second, but when we've had at least the first pullback, the first lower high, then we want to wait for the second lower high, then we've got a potential sell opportunity, then the third, another potential sell opportunity. Okay, that's this strategy in its most vanilla, easy, straightforward form. Okay, so how can we do this objectively? Okay, there's always, when we analyze the markets, there's always some level of subjectivity. We want to be as objective as possible as mechanical traders. Okay, so what we use to help clarify the markets for us is the moving averages. The 20, 50, and the 200, they're the best, in our opinion, at least, reflection of the short, medium, and long-term traders and what the dominant sentiment is in the market. So to qualify an upward trend even, we want the 20 above the 50 and we want the 50 above the 200. And we ideally want them sloping where we've got good order, which we've just discussed, angle, sloping upwards, and separation where there's at least some distance between them. Conversely, in a downward trend, we're looking for quite the opposite. We want the 200 EMA to be above the 50 EMA, and we want the 50 EMA to be above the 20. We want a decent sloping gradient between all three of them, and we want them to have a decent amount of space between each other. Okay, so an upward trend, as I'm sure you're aware from some of the basic textbooks or elementary courses out there, we're looking for higher highs and higher lows, higher peaks and higher troughs, with the moving averages in the correct order. They don't have to. The price doesn't have to be above all three moving averages. They can be bouncing in between all three of them. But as long as you've got the order there, then that's what we want. Okay, because we've got the medium, short, and long-term traders all singing from the same hymn sheet there. Okay, so conversely, in the downward trend, we want lower peaks and lower troughs. Lower highs and lower lows. Again, we want the moving averages to be in the correct order. The 200 with the 50 underneath, and the 20 below the 50. And of course, the lower peaks and lower troughs. It doesn't matter, once again, that the price action is below all three moving averages or not. We just want, the order of the moving averages to be in the correct order. That's it. The price action can be, painted over the moving averages. It doesn't really matter. Okay, so let's look at selling opportunities first. We want to get four things. Four more examples, including the fourth: selection, timing, and management. Okay, so what we want is we want the order of the moving averages, the prevailing downward trend, but we want at least 3 consecutive buy bars with a higher high and a higher low, okay, in order for a sell opportunity. You can see these 3, where we've got the orange circles here, we've got a potential opportunity to sell with this criteria, okay? So we've got extension, retracement, phase 1 extension, phase 2 retracement. And it's the retracement we're interested in. We want to sell at the top of the retracement, okay? So it's simply selling the rally in a downward trend. You've heard the old adage, selling the rally in a downward trend, but this is how we can actually do it properly. I know it's a lot of very much of a buzzword amongst a lot of analysts on television or on the radio or in the press, but how do we actually do it? Well, I'm going to show you. We're looking for a very specific activator bar here at the top of the retracement. It's in the form of a bearish pin bar reversal after our 3 buyer bars with 3 consecutive highs and consecutive lows. We're looking for a bearish pin bar reversal. It doesn't matter about the color. It could be a red seller bar. It could be a green seller bar. But crucially, we want the opener high to close in the bottom half of the bar. Okay, that's the crucial point. Okay, and then what? Well, very straightforward. We want to place an order below the low of this bearish pin bar reversal, minus spread, minus that additional pip, with our stop loss above the high. And then what we want to do, if we're triggered into the trade, we want to trail our stop loss for every second seller bar thereafter until we're either stopped out at a profit or indeed we hit our target. Okay, so our second bar trail strategy means that on one hand we can bank profit along the way, but we can also give the trade or the market enough room to breathe. And that's very, very important. Some people might look at this as a very aggressive way of trading. Well, it really is a trade-off between locking in profit and giving your trade enough room to breathe. And if we're trading for every second seller bar, if we're going short and above the high of every second seller bar, then that's a very objective way of doing that. Some people might just want to move their stop loss to break even once the trade is the equivalent distance between their entry and their stop loss in profit. That's absolutely fine. But this one is a nice, objective, easy style of management for you to take away with you as you so desire. Okay? So that's how we do it. Let's take a look here at Euro New Zealand, which we took on the 4th of June last year. This time last year, we had good order angular separation between the 200, the 50, and the 20. We're in a downward trend, making lower highs and lower lows just about. And we had this, it's bearish pin bar reversal, kind of doji-esque, open to interpretation. I know, depending on what software package you use. I know MetaTrader showed a bearish pin bar reversal that day. eSignal showed a bit of an evening star, really. But our entry was below the low, stop loss above the high, and then what happened was you trailed it for every second seller bar thereafter. The great thing about these short setups is the old adage rings true. The bull climbs up the stairs, the bear falls out the window. So any sell setups, they typically go rather quickly, and that's what we wanted, and that's what we got here. And this is a very similar setup to what we're currently trading in Euro GBP short at the moment, and we got triggered into this trade at the beginning of this week. So we made 5.1% gain, risking 1% of our trading account on this trade setup. Let's have a look at how we can trade this strategy long. Okay. So buying opportunities in an upward trend, we're going to discuss timing, selection, management again. So once again, we're looking for price action to be making higher highs and higher lows. We want the 200, the 50, and the 20 to be in order, preferably angled, preferably with some distance between them. It's not essential to have the distance between them. What we're interested in here is the pullback. We've got the extension of the buyer bars, the pullback, the seller bars, where there's been profit being realized. We're really interested in just simply buying the dip here in anticipation of the continuation. Okay, so what we want to qualify this is 3 consecutive seller bars with a lower high and a lower low, and we're looking for an activator bar thereafter after that criteria has been met. And that could be the form of a bullish pin bar reversal, where we've got the the open and close in the top half of the bar after 3 consecutive seller bars with the lower high and the lower low. And it doesn't matter, once again, on the color, as long as you've got the tail, the rejection, and the open and close in the top half of the top third, then we're going to be very happy with a potential long setup. How do we trade that one? Well, just the same as we discussed for the short, except the other way around. We place our entry above the high, plus spread, plus an additional pip, with our stop loss below the low, minus spread, minus an additional pip, and then we look to simply, let me just trail. If the trade goes in our favor, if we're triggered into the trade within 3 days, we're looking to trail our stop loss behind the low of every second buyer bar, so that we can once again objectively lock in profit and simply just give the trade enough room to breathe. And that's, once again, let me reiterate, very important. On one hand, we want to lock in profit, and on the other hand, we want to give our trade enough room to breathe in the event of retracement. That's very important. Okay, so this is a recent one. This is, what happened on, I think, the 7th of May when we had the election results. We had a hedge. We had a pound Aussie long setup on the daily, and we had a pound yen short setup on the weekly. So we placed a long trade for the daily and a short setup for the weekly, just in case. Because who knows? I mean, the opinion polls for Labour and the Conservatives were neck and neck. Even though the Tories won, we expected the market would receive that quite favourably. And of course, it did. Our pound yen short trade didn't get triggered, thank goodness. But this one did, and it was in the direction of what we anticipated. We had this huge buyer bar. We had a impulse move upwards, and we could then, if we wanted to, trail for every second a buyer bar, and we did. And we had additional opportunities to buy since then on this. So we made a sly 2% gain, risking 1% on this trade. Okay, and this is why we don't really care about news, because if we have a decent reward to risk profile, which we did, then regardless of the news, it's 50-50 whether the news is going to be in our favor or not. If it does go in our favor, 50% chance it will, then at least we can make a lot more in percentage points than we stand to lose if in the 50% chance that it goes against us. All right, so that's the great thing about high reward to risk trade setups. If we're right, we're proven to be very right. If we're wrong, then, well, at least we only stand to lose a small amount. It's like flipping, for those people in the UK, a 50p coin, betting on heads or tails. It's a 50-50 chance it's going to land on heads or tails, but knowing if you're right and it lands on heads, then you win, say, £300, and if you're wrong and it lands on tails, then you lose £100, then it's a worthwhile proposition. You're going to keep on flipping that coin. Well, hopefully there won't be too many black swans along the way, but try it. I mean, it's a worthwhile exercise. Okay, so I'm just going to talk to you very quickly about a trade we're in at the moment, Euro GBP, and then we'll move on. Let's look here. There we go. So here we are, currently in this one live for a short. Let me just simulate this one to show exactly what we did for your information. Okay, so as you can see here, we're in a projected downward trend, and we had a box or rectangular box here, which the market broke out of before, and we're anticipating that it's going to happen, well, again, this time round. But it will make sense to simply sell at the top of this box rather than wait for the breakout at the bottom, because we can get a much better reward to risk if it does break this level of support here. So what happened is we had a bearish pin bar reversal here. On the 9th of June, we had reversal divergence on the RSI, lower high here, even though price made a higher high. And if we look on the hourly, it looked like it could have potentially formed a double top formation. And when we took it price was around about here. So we knew that even if price just came down to here and ricocheted off and came back up again, then at least we could potentially lock in a one-to-one trade, okay? But the setup was there. We had decent order angle and separation between the moving averages, 200 above the 50, 50 above the 20, just about, even though we're range bound here. When the market is range bound, typically we get, even though it's lagging here, moving averages moving sideways. It's still valid just about here. But what we're interested in is the reward to risk. And this is why I like to keep trades quite simple, because it's simply selling the top of the range here. We had a signal to go short here, and we're just waiting for price to leave this congestion zone here and come to the bottom preferably. That's a decent, let's have a look here. We had about 65 pips difference between our entry and our stop loss, and we're targeting 251. 251 divided by 65 is 3.8 to 1. Of course, we'll trade it for every second seller bar. Our stop loss above the high of every second seller bar, and we will do just that. If we wanted to be conservative in our stop loss management, those people who want to obviously realize an all or nothing trade, like for example, if they're happy to let the market retrace a decent amount and let the unbanked profit come off the table in anticipation of a much bigger reward potential, then they might have to go through that stomach churning retracement, which could pay off in their favor or not. Okay, so that's the trade-off with this. But this setup here, this is Euro GBP, and the great thing about this one as well is, and this is something extra I look at, is seasonality. And we know full well that the British government, or sorry, the Bank of England, not the government, they're going to potentially increase interest rates come September, which is going to be great for the British pound, not so good for the FTSE. Why is it not going to be good for the FTSE? Well, it's because if money's a little bit more expensive to borrow, that's going to dampen appetite for stocks, essentially. And so it'd be good for the British pound in appreciating in value against the US dollar, but bad for the FTSE listed stocks, and we'll see inevitable fall there. All right, so let's go back to Euro GBP. Another factor as well, which I want to really bring to your attention, is seasonality. Okay, and I'm going to introduce a website to you called equityclub.com, and let's just write that in now. Equityclub.com. It gives you a good heads up into how charts or currency pairs or anything really fare at different times of the year. Okay, so it's just extra confirmation really. So for example, if we're short Euro GBP, we're essentially selling the euro and long on the British pound. So here we go. How does euro fare typically at this time of year throughout summer? Let's find out. Okay, so June, we can see that euro is just stagnating here and moving sideways, which is nothing really to write home about, is it? Whereas if we compare that to the British pound, cable, where are you? There we go. June, well, we have a bit of a drop in the first week, but seasonality dictates that over the past 20 years, cable has traditionally, or the British pound has traditionally rallied throughout, well, from the second week of June throughout July and the beginning of August. We've traditionally seen a bit of a fall here. August is a bit of a dud month to trade because a lot of people tend to go on holiday there, and a lot of the institutions, financial institutions, are just waiting and seeing for when things come back to in sync in September, October. That's when we typically see some big movements once again. August, I know people who take the whole month of August off for that reason. Okay, I personally don't, because the amount of trades, the amount of trades I take aren't very many at all. So I'm just seeing a question here. FX Boyke, hello again. I recognize your name. Smash the time money link. Yeah, we actually discussed this one. Okay, so we had that example. Well, let's go back to that example. Okay. So smashing the time money link. Okay, so I'm just going to go over it again. I don't know if you were around when we went through this one. So we discussed, in terms of smashing the time money link, the returns made in trading are disproportionate to the time spent in front of the screen. So we have two examples here of Jack and John. Jack's a end-of-day trader who trades from 30 minutes a day, whereas John is an intraday trader who spends, well, hours every day intraday trading, looking for the opportunity. Okay, so if we have 22 trading days in a month, Jack, the end-of-day trader, has spent 11 hours spent glued to the screen looking for trades, whereas John has spent 88 hours Supposing they make, okay, 8% each, who do you think has made the better return for the time spent in front of the screen? Jack or John? Well, it's going to be Jack. He's had a much better return realized for the time spent because he's made the same, well, he's made 0.7% per hour, whereas John has made 0.09% gain per hour. And you've got to consider this one. If you're trading with a smaller account, like $1,000 or even a $10,000 account, consider this. Even if you're making like 2% a month or 4% a month trading intraday and you're spending 4 hours a day trading, 4% a month is fantastic, by the way. But do you really think you're going to make a full-time living through doing that, trading with a $10,000 account? Unfortunately, I don't think it's likely. And 20% a year return with leverage is a great return, or even without leverage. I mean, Warren Buffett has been making that consistently. I know he's an investor, but that's a fantastic return to have per year. But on even a $1,000, $10,000 or $50,000 account, is that going to pay for your bills, your children's education, your mortgage? Not really, I don't think so. However, what it's good to do is to build up a track record of your trading on the smaller trading accounts, or indeed a bigger trading account with a less time-intensive strategy so that you can at least get a much better return for the money spent. And of course, as you become more confident in the markets and over time, you can unlock the doors to more capital and you can capitalize yourself. Okay, so let's move on. I know we're coming to the end of our presentation here. Okay, so I just want to talk to you very quickly. I know it's a beautiful day outside if you're in London. I just want to talk to you about this exclusive offer we've got only with FX Street and today only, valued at 1,999.7. I want to reward you today for taking time out, to learn about financial markets trading. And I'm going to give you 1 month's access to our flagship Ultimate course for $30 instead of $252. Basically gives you access to all of our strategies, both basic and advanced, 10 hours plus of video tutorials. We've got over 40 years experience underpinning all of our materials with Julian McCree, Kaylee and myself. We've got even trader hypnosis, audio course and wealth programming audio courses. We've got pattern recognition software. We've got trade ideas, which we drip feed to your email box as and when trades occur. We've also got weekly market analysis. Okay, so we've got an 88% discount. All you need to do to get your place is go to www.thelazytrader.com/forex trading, buy the ultimate program, use the coupon code or promo code FX Street June to get your discount, and you'll get all of this for $30. Okay. That's the best that we can do. That's the best we're going to do. And it's until midnight tonight this offer expires. Okay, so hopefully see you on the other side. And if it makes you feel any better, by the way, if you're not 100% happy, you can get a full refund. No questions asked. Okay, it's, it's doesn't get better than this, really. But anyway, hopefully it's for you. Hopefully see you on the other side. If anyone's got any questions about what we've gone through in the webinar, feel free to shoot and I'll answer them. Let's have a look here. We've got Boltayev. Yep, sure. Doesn't mean we can't trade in the summer months. You can do, but I would only trade really if the setup has good reward to risk and it's on the higher time frames. August, you'll find that volume's a lot thinner. There are a lot of false starts. I'll be tempted to be quite judicious about the setups you take in August. All right. Okay, then. Well, I'm going to be around for a little bit longer, for a few more minutes. If anyone's got any questions, do let me know. But for the meantime, I'll say hopefully see you on the Lazy Traders Ultimate Program. Only $30. Hopefully see you on the other side. Failing that, thank you very much indeed for your time. I wish you well. What was the website? It's www.thelazytrader.com Forex training. Let me type that in for you. Okay, sorry, the other one, equityclock.com. That's the website which gives us free seasonal information. Okay, sorry, let me paste these links in chat. My apologies. I was sending them to the moderator without meaning to. There we go. All right then. Well, that's it from me. Have a wonderful time. And I will see you next month, potentially. I'll be in Malaysia, so hopefully the internet connection will be stable. But I will see you then.